Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I offer in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good afternoon. Ira Epstein of Linn & Associates with your financial market update, and this is for Wednesday. We're at the 9th of August, 2017, about 4:05 p.m. Central Daylight Time. Are you yet hearing enough about North Korea? They're calling it NOCO already. I mean, it's just funny what the press does with this. And I'm wondering just what really is going on. For those of you that get my newsletter, you know, I wrote this today that I thought that what President Trump did yesterday was planned. I kept looking at that video, and he's looking down at his notes. You don't just show up at a conference like he did, not about this at all, and have notes on the North Korea situation with his wording ready to go. And he was clearly looking at it. And my guess has personally been that he's trying to find ways to get others being other countries, to put pressure on China to, number one, make sure that the sanctions aren't just words. We've seen sanctions that take forever to kick in because nobody pays attention to them. We want them to pay attention. We want them to talk to North Korea enough and say, you know, the pressure's coming from everybody. This really has to stop. That doesn't mean the North Koreans will stop, but they have 60, maybe 60 nuclear weapons. One's enough to create havoc, we know. We have 5,000. So they can say all they want, and we can say all we want. And I think what happened here is the president studied Mr. Truman, President Truman, looked at what he told Japan, and he followed the playbook. Doesn't mean he's going to follow the playbook in dropping the bomb, but also remember, we don't have troops on the ground per se there. They're across the border, not very far. So there's similarities. The stock market came back from its lows. It does not believe, in the simplest of terms, that this is going to propel itself very far. For those of you that saw me today on Fox and or Bloomberg, I was on both TV shows. I said the VIX, each time it's gotten over 12, it doesn't stay there very long. It's already back, closed on the lows of the day, barely higher. The gold market is up, and in fact, in the aftermarket, it was up about $3 more than this, and most of the stock indices were higher than this in the last trades of the day. So, barring the war of words picking up further, I question just how far this is all going to carry. Now, when we look at the S&P for the week, you have already an outside week. You've taken out last week's low and high, and for the week, you are up 1 point. I mean, it's pretty interesting, isn't it? When we take a look at a daily bar chart, look at the extremes already from up here where the market got as high as 24.88.5. Now you hit 24.59. So you've broken about 130 points. The market came back and finished the day practically unchanged, a quarter point higher. When we take a look at the swing line, that has set up your trading range. You now have your high. I don't know that this is yet the low, but I'm betting it's going to be close to it as the low, and the market coming back up. You want to know why I think that might be the low? Remember when we get to the Bollinger Band chart, and I'll come back to this. In terms of moving averages, the market is playing against the 18-day average of closes. So far, the 100-day average is out of play. What that means is because the 18 is over it, you've got a bullish setup. And again, you still haven't closed under this 18-day average since the first days of July, even though it's a break. When we come over, let me come over to this chart, the Bollinger Bands. I want to be sure I was on the right one. 24.60.70, that's the low Bollinger Band. You got to 24.59, you came back and you closed at the 18-day average. So all you've done, you went from your upper band to the lower band in a 48-hour period, the two total days, but it was really a 24-hour period because you closed on your low nearly yesterday, down and back up. Amazing. And you're right at that 18-day average. Now, these bands have narrowed in. When they narrow in this much, inevitably, they'll narrow in and get a little length to them, and from there, another trend takes over. So we're at that point where this is the pause. Now, you don't have to believe me. You can believe the news announcers. God bless you. But I call this pretty much sideways action. And we've been in this pause now for a while, and you're finally seeing it with the Bollinger Bands. Momentum is diverted from price. It is pointing down as the market is over the 18-day average having an upside bias. So fighting with each other, certainly not staying together. And I think you'd agree, when you lost that embedded reading, you lost the upside momentum. When we get to the NASDAQ, take a look at today's low, 5861.75. Let's look at yesterday and get an idea of what this market looks like. Gets up, hits the upper band, comes back and settles just over the 18-day average. Market's still looking okay. It has a pattern of higher lows, higher highs, but it has hit its upside target. If the market gets under the lower number right here, well, that puts into play the potential for the lower Bollinger Band. The Bollinger Band obviously moves up because it's paying attention to the day's range. The market gets to 5861.75 through the 5864.60. The pros, I think, took their quick action, and like the S&P, they are sitting here looking to see what next, and we are not getting momentum in this case leading price at all. It's actually pretty flat, and price action has gone flat. The Dow is different, and it's different because the embedded reading is still at work in it. If it loses the embedded reading, if this red line closes under 80, the odds are strong that price and the 18-day average will come together. However, until that occurs, you still are under the influence of higher lows and higher highs. In play is still the upper Bollinger Band if the market wants to go back up, and there is nothing yet bearish on this chart. In the Russell, if we take a look at the events, and I want to get rid of today's action, here is a market with a pattern of lower high, lower low. We're already bearish. We are oversold. If the market continues down, go to yesterday's video. I would probably say, looks to me like you got the potential for support between 1402 and 1396, but this is the weakest of the charts. Today's action, you tell me what you did. I don't know that it won't go lower, but you're into that support, and the market did not give you much of a bounce from it. It is the weakest of all these, but it is oversold, and it has hit two downside targets, so you do with it what you want. In the VIX, for those of you that were looking this morning at the market, I know I said in my subscriber videos, and I'm saying it again, and I said it on Fox today in the afternoon at 2:15. I said, you know, each time we've gotten up here over that 12 area, and we've done it since March, and that's what I have told them on numerous occasions. The market in a matter of days has come back to that 18-day average of closes. I don't have magic. I can't foretell the future, but I don't see this as being overly that bullish in the market. And if it pulls back to 1003, all I'm going to say is I told you so. The market hasn't been able to hold a big rally, and coming back in the stock market the way it did probably puts pressure on it. Bonds and notes. We had buys into these in terms of the momentum of safe haven thinking. You have the pattern of higher lows, higher highs. Again, you went up today right to the upper Bollinger Band, and you're running into trouble at it. It's that simple. The high today was 155.8. The Bollinger Band top is 155.8. That's where I think the pros were bailing. And now that doesn't mean they're out of all their positions, but I think it gives them power to take another look at the market. I don't think they're going to want to see the market get under this break low of this day, of yesterday. And yesterday, let's go into that for a moment. We had an outside day down yesterday that set the chart up with a pattern of lower highs and lower lows. The market finished one tick above the 18-day average of closes, so even though the swing line was down, you didn't have the bias turn down. Momentum did turn down. What's my rule on an outside day? That if you take out an outside day downs high, the market often, I wish I could say it better than that, makes a run at the upper Bollinger Band. That's what my work has shown me over the years. It's exactly what happened again today. Let's talk about the 10-year notes. 10-year notes had the same pattern. Okay. And what did the market do? Here's your Bollinger top, took it out. So I think that you're at these points in these markets where they've already discounted what's going on, and unless things accelerate in some manner between North Korea and America, that if diplomacy kicks in, this comes out of the market immediately and we're back to more normal type trade. In the dollar index, you've been under the influence of a pattern of higher lows and higher highs. You went up yesterday to the 18-day average. You hit it again today, and you're not going anywhere. That's a problem. Was this the rally in the dollar? And if you take out 93.12, are you really saying, well, that was it, folks, and maybe now the bullish bias that the market developed for all of a week is dissipating? In the euro currency, it's the flip-flop. Lower highs, lower lows. The trade bought, I think, the market and supported it against the 18-day average. If the market gets over the 118.48 level, like the dollar, I'll say, was that the whole correction? I don't know that that's going to be the case. You know, we have Jackson Hole coming up where the Fed, our Fed, holds the meeting of central bankers. And I'm wondering if these markets are already into that mode and not going to make any big moves before that. Something for you, not me, to think about, because it's your money that you're trading. When you go to the Aussie dollar, as far as I'm concerned, you're very close to this lower Bollinger Band. I'd be pretty careful about wanting to be short much more in an oversold market. It is definitely in a downtrend. The bias is down. I'm not saying it can't go lower, but it is close to, hasn't quite hit the target, and oversold. Japanese yen, you would think that a series of events when you get a war threat that could be very real, you get buying in typically U.S. Treasuries. You might get the buying in the gold. You got that. You might get the buying in the Swiss franc. You certainly got that today. And the yen. So safe haven currencies and precious metals and treasuries. It happened. Take a look at the high, 91.44 and a fraction. Today's high, 91.42, and you are overbought as can be. I'm telling you, be very careful is all I'm saying. Here's the good news on the yen. You had a bullish crossover. The 18-day average did get over the 100. So on a pullback, this zone is going to be very important. I'm not saying you'll hit those prices, but that's a zone that's going to have a lot going for it. In the crude oil market, well, this market is overbought. If you look at yesterday, the numbers settled at 77. The day before, though, they were embedded. Do you agree? The day before, both numbers over 80, and the day before, not. So what we've got is a market that's just staying overbought. It's not embedding. It's got days to go if it could. The pattern is lower highs, lower lows, but you're over the 18-day average. I told you you're probably going to get these averages to try to come together. They might just kiss, where they skim and the 18 turns back under, or if the 18 gets over the 100, well, maybe you're going to go back up to the 51 level. The bias is up, overbought, and the swing line down. I don't know what to do with it. In the gasoline, this is where I think the market has to make a stand if it's going to be any good at all. You've come from the upper Bollinger Band back to the 18-day average. You lost the bullish embedded reading. Yesterday, you hit down into the 18-day average. You held it today. The EIA report that came out today and showed the gasoline stocks was ugly. The report yesterday in the API, ugly. And what's ugly? We are drawing more crude oil out of stock. The refinery rate is up to 96 and a fraction. So the refineries are taking oil out of stock. They're making distillates and gasoline products with it. And unfortunately, the gasoline is not being drawn down. So the gradual stocks are not coming down as we'd expect at this point. And that means if they get caught with big gasoline stocks as we come into the end of the summertime, watch out. They'll suddenly be shutting down maybe a bit earlier for the winter conversions back to the different blends for the wintertime. A lot of things happen. We will see. 2 weeks don't prove a thing. The good news is overall that the stocks continue to fall. Nat gas had a good rally today. Market lost its embedded reading. I doubt it's going to get it back tomorrow. So this market's got a pattern here where they caught the shorts. And now the question is, do they let them out by dropping again tomorrow? But the downtrend Maybe the market got too short when it was down into the 270s, and that might have been it. But that chart turned from bearish to ugly for the people that were bearish. It's not bullish. It's no longer bearish, and that's the problem that you have with it. Our good friends at Modern Trader, their new issue is out. So now we have the September issue, and it's all about, believe it or not, and Chicago's got to love it, steakhouses, but beef, trading ideas, how to play this sector of the market. It's pretty fascinating. So they call it the issue with restaurant stocks, but it's much more than that. You're going to be able to talk earnings, pairs trades, Forex, the Fed ahead of the curve, ETFs that look at the restaurant parts of it. Then you're going to get the different trading techniques that come out. So finally they did something a little bit different that I like. They picked an area that we all like to go to typically, not the vegans out there, I know it, but steakhouses are very popular. But then they're taking you into the technical trade, how you can look at some of these charts on them, what do you do with it, and they teach from that perspective. They back it up with daily market focus. So whole new type of look in the magazine, something I love. You get it free, and it's a $79 a year value, free from us. Call us. Go to our website, www.iraepstein.com. Click up here if you're watching me on YouTube, this icon, or underneath us, you'll see the wording. Click here for Ira's free offers. Do so. The forms will appear if you see us on our website with that, and away you go. I'm Ira. You have a great day, and I will talk to you all tomorrow.